Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, April 25th, and then we'll see how things look for Wednesday, April 26th. We had a pretty significant down day. Basically, the conclusion that I'm coming to is we saw a lot of negative divergences that were building and building and building, and they all started to come together in Tuesday's session. Now we have to try to decide, is this a pullback before we get set to go higher, or are we seeing an actual shift? At this point, the shift was pretty severe, and we pretty much have changed over to negative now. There are some positive things that we can lean on, and I'll point those out throughout the video, but now we have to take more of a defensive stance or looking at taking advantage of some downward movement until we see more evidence that the move was overdone, and now we're getting set to go higher. Also, way in the background, and I'll point that out in this video as well, we still have some real positive backdrops. These are bigger picture things that we look at that cover the whole year or cover even longer than that have typically led to good results in the long run, but it doesn't mean we're going to go straight up right from there. But we can still keep those in the back of our mind as we're making our decisions. Before I get started, please be aware that I am traveling. That's why my sound is a lot different. I've actually had a few people say the sound is better, but that's okay. The main thing is, can you hear it clearly? Please be aware that I do have a podcast, and both in the videos on YouTube and in the podcast, I have a PDF that I post every day that has all of the slides and charts. You can download that and then follow that as I go through the charts throughout the video. I do have a private Facebook group, and I'm starting to post a lot more things to that area. The Isabel Net charts, other things that I run across, maybe on Twitter or other people that I kind of follow. If I see something interesting for right now, I'm pretty much sticking them there. My goal is to give you as good of a video as I can without it taking forever. I like to keep these videos right around 20 minutes. They had been getting up to closer to 30 minutes. I'm trying to drop that back more to the 20-minute category. There are a lot of other platforms out there. Please let me know if you use these. I have a blog. It's SPXInvestingblog.com. That's also in the description. You're welcome to go there. I'm not posting any articles there now, but I could easily do that. I do post things on Twitter, Instagram, LinkedIn, Blogger. I do have kind of an ancient blog on Tumblr, but I haven't used that in quite a while. But if there is a social media platform that you like that I'm not posting to right now and that would help you, please let me know. And that's not just for right now. That goes for any time into the future. There is a poll that is posted and you're welcome to take part in that. Let's go back and talk about what happened. We did have a gap lower open and prices fell below S1 at 41.22. We tried to find support at S2 at 41.08, but that failed. As the day went on, we fell below the 4100 level. That was an area of support that we were keeping an eye on. We went all the way down to S3 at 40.83. That level didn't last very long in and of itself. We tried to bounce back up from that, but now what had been support becomes resistance. And then we closed at the low for the day. We were down 1.58% on above average volume. That is pretty important. The whole rise up that we've been seeing thus far was on below average volume, and now we have a big down day on above average volume. That is critical. The technicals have now switched back over to negative, pretty much for the most part. We even have a few that have already gotten to the oversold condition or extreme negative, and a lot of this has to do with the inflation and interest rate concerns that the markets are dealing with. We have earnings that are coming out on a stock-by-stock basis, any Fed speak that we get, and then more banking information that may be coming forth. Here's the intraday chart showing how we gapped lower. We quickly went down below S1, made it down to S2, tried to set up a little bit of a base and a bounce from here. That wasn't going anywhere, so we fell down through S2 and then came all the way down to S3, which I had to add on this chart myself. We fell down below that. That then became resistance, and then going into the close, we saw some more weakness. Both growth and value were down on the day, but growth actually held up a little bit better. If you can see here on the chart, with large cap growth being down 1.47% less than the 1.63% for large cap value. They also did better with the mid caps as well as the small caps. The last few weeks, we've been seeing more of that rotation that we were seeing a lot in 2022, where people were getting out of growth and getting into value. Well, this was mainly a value sale. Now, growth went down with it, but to see value leading the way lower might be setting the market up for a shift back into more growth investments. Here's the intraday chart, where we went negative pretty much during the night, and then in the overnight session going into the pre-market session we were negative, and then right off the bat we gapped lower going all the way down to the low, and then there was a bit of a bounce because there's some earnings reports that came out, and that did help the futures a little bit. And when I checked right before recording, we're up about 0.5%, but this is still many hours before the market even opens and anything can change. What are some comments that we can make? Growth was down less than value, as I did point out. First Republic Bank came out with their earnings report, and no surprise here, it was disappointing. It also included a 40% decline in deposits. Would you stick your money into First Republic Bank right now? And then there were some other negative news items that did not help the plight of First Republic Bank. The banking sector concerns seem to be getting rekindled now. We're just wondering, are there going to be more shoes to drop in this whole thing? And then UPS came out with their earnings, which were pretty good, but then they weren't looking all that great going forward, so their stock got crushed. On a short-term basis, we still have our long-term stochastics that's extreme positive, but on a short-term basis for looking at oversold indications, the stochastics have already dropped down. The CCI is already there. The force index, the Stoch RSI, and the Williams percent are. We've spent a number of days, in fact weeks, pretty much not trending in the market. So when we get a big move, either up or down, that can throw us into an overbought or oversold condition fairly quickly. The dollar was up and interest rates were down. The 30 to the 5 is back to being normal. All of our other yield curves are still inverted. Sentiment is still positive. It's ticking down. It had been at 63, now it's at 57, but we're still in that positive area. Our trend, there's been changes now. The ADX really picked up on what happened in the session. The red line is now on top, and since it's going up, it's a strengthening negative trend. But when you look at the ADX, it's now dropped below the moving average, so that in and of itself is weakening, but everything is still under 20. When we look at the ADX and the moving average, our bias is now negative and our momentum has now been switched over to negative. The economic reports that came out, we had the FHFA housing price index. It was up 0.5%. Last time it was up 0.1%. The S&P Case-Shiller home price index down 0.4%. They expected it to be unchanged. Last time it was up 2.6%. New home sales were up 9.6% month over month. If you compute that up to a year, it's 683,000 units more than the 630,000 they had expected. Last time the report came out was 623,000. On a year-over-year basis, new home sales were down 3.4%. Consumer confidence came out, which is interesting because that wasn't on the calendar that I usually look at. It came in at 101.3, less than the 104.1 they had expected. Last time it came out at 104. A year ago, consumer confidence was at 108.6, so it has dropped on a year-over-year basis. Let's go back and look at our charts. The Ulcer Index ticked up just slightly, but it's still showing that there's not an awful lot of fear. If we're really getting ready to move to the downside, we need the Ulcer Index and the VIX and our other sentiment gauges to really kick into gear, and they're not really doing that yet. Here's a longer look at the Ulcer Index. The reason why I bring this up is we hit a pretty low level with this indicator along the bottom here, showing that there's not an awful lot of fear, and typically that will mark some kind of a top in the market. Here is the VIX. Yeah, it went back up, but it's still under 20, both with the line chart and with the bar chart. And we closed well off of the high on the bar chart, which is kind of interesting since we closed at the low. The VIX of the VIX ticked back up a little bit. We did see some action with the VIX of the VIX going up right during options expiration, and now that seems to be calming down. We're not seeing anything really with the SKU index. Now, the VIX measures at the money options, where the SKU index looks at out of the money options, both above and below current prices. it's giving us a reading that I would pretty much take as neutral right now. We're not up in this red area on the top. We're not down in the blue area on the bottom. This is a new chart that I haven't shown before. I've been watching this for a while to see if we can get anything from it. It's a ratio of the VIX to the VIX of the VIX. And this works just like the VIX does. When it's going up, there's a lot of fear. When this is going down, that means that there's a lot of complacency or less fear. And we're just tracking this over time. And it had been declining. Well, with Tuesday's decline, it started to bounce back up. On the bottom, you have a 50-period exponential moving average of this ratio, just to get the overall trend. When we really started to hit problems in early 2022, you can see how this was pretty much going up every step of the way. When things started to switch over positive in late 2022, when we potentially hit that bottom, this has been continuing to come down, shifting things more positive. The equity put call ratio spiked up a little bit, but we're not up at this 0.8 level yet, so it's not generating a new signal. We did see a bit of a tick up in fear with this one fear gauge that we look at, as well as this other fear gauge. You can see where it just barely went up. Folks are still having a tendency to get out of stocks and get into bonds. That's called a risk-off posture. This ratio continues to decline, suggesting that that method is still happening. Here's the big changes with the ADX. The red line has now crossed above the green line, so now we default to the negative trend. Now, if you're really aggressive, and you might get into some kind of short positions, whether they're puts or inverse ETFs or inverse mutual funds, but that's for really aggressive folks, because down below here we have the ADX, which is not trending now, and it's actually turning down. Some of this has to do with the fact that the red line and the green line are crossing each other. If they get far apart, then we'll see the ADX start to turn back up. For those of you that are more conservative, you're going to want to wait until the ADX actually does get back above the moving average. That's step number one. And then can it break above 20 for step number two? You can use this in a more aggressive way or in a more conservative way. Each person is a little bit different. Looking at the Arun, after giving us an extreme positive reading, it's now starting to decline. Buyers are starting to trail off as sellers are starting to pick up. The daily chart just shows how we got up to this resistance level or thereabouts, and now it looks like we're starting to fall down. And it's kind of hard to see with all these pivot points calculated right here. And then the bottom, you can see where we finally went above the moving average. Now, if we continue to fall, we're going to be watching the 50-period moving average. That's also coming up to a support level. If we fall below that, there's another support level. And then below that is the 200-day moving average. And we still have quite a ways to go to get back down to this downward sloping trend line. The CCI 14 just barely extreme negative. It still has more room to fall. We dropped below the 20-period moving averages. In yesterday's video, I said this is the level that we would be watching at about 4,100. Well, we just sliced through that pretty quickly and closed below that. So on a short-term basis, this has also turned us back more negative. The Stochk RSI has also become extreme negative, and the Williams percent R. These are two of our touchy indicators. It doesn't take much of a move to generate an extreme reading, especially when we have not been trending. The stochastic on a short-term basis, we're already extreme negative. We dropped below 50 with the intermediate term. We're still extreme positive with the long term, but it is turning down. The force index has dropped below zero, and now we're starting to hit this lower Keltner band, so that means we've moved down pretty far, pretty fast. Looking at our oscillators, the slope has now turned over negative. The TSI has also switched over negative. Those are our short-term oscillators. Intermediate term, we were watching the MACD in yesterday's video. It's now crossed negative. The PMO is just about ready to cross, and I have the PMO study to show you. The PPO is crossed over negative. These are our intermediate term oscillators. Then on the bottom, our long-term oscillators, the TRIX is rolling over and the KST is starting to roll over, but they haven't switched negative yet. Now we'll be watching the 50-period moving average. This is at about the 40.51 level. For the exponential moving average, that's blue. Most people use the simple moving average, which is in red, and that's currently at 40.35. The moving average tree showing how we drop down below the 20-period moving averages, with the 50s coming next if we continue to fall. Here's another thing. After getting up into this second standard deviation and staying up there, that was more positive. we drop back down into the first standard deviation. Well, what's more negative on this chart is we now close down below the midpoint. That's the dashed line, and we're in the first negative standard deviation, or you could say -1 standard deviation. The Bollinger Bands, we drop below the midpoint with them as well. This is another indicator that I created a long time ago. It's a 20-period simple moving average of the open, high, low, and close. When we're going up and we fall back, sometimes these areas will act as support. We slice through all of them pretty quickly. The parabolic SAR, which was one of our very first indicators to switch over negative, continues to be negative. The Swindlen Trading Oscillator, based on price and volume, we had been noticing this negative divergence where price was going up, but volume was going sideways. In yesterday's video, we had dropped below 0 based on volume. We were still positive based on price. Now both of them have dropped below 0, so that's turning things more negative. The Vortex is also crossing over negative with the red line crossing above the green line. The Chaikin Oscillator is also turning down, but it's still above 0 because it has a ways to fall yet if we continue to go down. The S&P Utilities ratio, that just hasn't really been doing anything. In fact, it declined overall. That was one of the warning signs as we were going up that we just weren't seeing any strength right here. Looking at our PMO, we're not quite crossed yet with the PMO itself, but based on price, we're just getting ready to cross, and we've already crossed negative based on volume. Here's the PMO study. The PMO is rising. Now it's falling and below 50, so that's negative. We're coming down with the buy signals, and we're rolling over with the PMOs that are above 0. The BPI also fell down, but it's still above 50 overall. And then the broader range BPI, based on the NYSE, we dropped back below 50. The Chaikin Money Flow, this one's still hanging in there pretty good. Yeah, it fell, but it's still giving us a pretty good reading. You could make a case that when we really went higher, that was an extreme positive reading, and now we're pulling back from that. The Balance of Power still above the dashed line, but declining. TTM Squeeze, we're seeing more and more darker blue bars, but they're still positive, but they are descending. The Go No Go has continued to show a neutral light blue bar, and we dropped below the 50-period double and triple exponential moving averages, and we closed just slightly below the moving average going back to the all-time high. Here's another look at that also, showing how we've come back down and we're just a little bit below the anchored moving average. Our fib levels, after staying above this 100% retracement at 41.23, we now fell down below that. The next level of support for the short term is at the 4009 level. Longer term fib chart, we were never able to break above this resistance level, and we've now been falling back. If we continue to fall, this chart is suggesting 4000 could be a support level. Longer term, we still have 4020 down below current price. We never were able to get above this quadrant area up here that acted as significant overhead resistance, and now we're starting to fall back. The equal weight index continues to underperform the S&P 500 index, and we're pretty much chopping sideways with our ratio between the S&P 500 and the equal weight S&P 500. The Elder Impulse System for the S&P has switched to negative. McClellan Oscillator has dropped below 0. The NYSE McClellan Oscillator has also dropped below 0. Our summation index based on price turned down, and we had a few days warning for this where volume had already turned down. Heikin Ashi starting to show darker candles. That is more negative. 3-line break also starting to redraw with some dark candles. That is negative. Looking at the new take on Dow theory, we've now dropped down below this blue line, which had been holding up so far for the S&P. We never were able to get above this blue line for the NASDAQ, and now we're starting to roll back over. The transports continue to underperform the Dow. Looking at new highs, new lows, the bars up here make you think, maybe things are getting better. We're just not seeing any improvement with our 5-period simple moving average. The 10-period is still advancing. But if we see follow-through weakness, both of these could continue to roll over. The advanced decline line, we had also been working off this longer-term negative divergence, which now may be coming into play. We turned down based on price, but even more negative, we dropped below the moving average based on volume. The advanced decline line, which is based on price for the NYSE, we're coming back down to the 50-period moving average. Can that act as support? We're still seeing an even longer-term negative divergence where we made a higher low based on price, but a lower low based on volume. And that seems to be where a lot of the weakness is coming from. And that's why I kept talking about volume day after day after day. We're just seeing below average volume, which it's like building something on sand. And then once you take that sand away, everything falls pretty quick. Here's another chart that I recreated based on another chart that I showed a couple days ago. This top area just says what percent of stocks are above their 200 days moving average that are inside the S&P. S&P had been going up, but the stocks above their 200-day moving average had not been going up and now are starting to roll over. The same thing is true at the bottom. What are the stocks inside the S&P 500 that are above their 50-period moving average? We were not seeing any real strength in this area either, and now that's beginning to roll over. Another area where we almost came up to a previous high, but with the NYSE cumulative advanced decline line, we weren't even close, and now we're rolling over with this measurement. And the advanced decline line also did not come as close as the S&P did to a previous high, and now it's beginning to roll over. We're right down at about the 50-period moving average. The advanced decline ratio is still positive, but it is declining. Accumulation distribution. This is still hanging in there. Yeah, it was down, but it's still above an advancing moving average. Volume is starting to pick up, not only with options expiration not very long ago, but then the big down day on Tuesday really saw an increase in volume. The money flow index did decline, but it's still above 50. The ultimate oscillator, same thing, dropped but above 50. On balance volume dropped, but is still above an advancing moving average. The special K, this is a long-term oscillator that we use for major trend changes. So one possible scenario just to keep in your mind is that, yeah, we're working off this overbought condition. The market was chopping sideways. Once this gets done, if we're going to turn and go back up, we would then see this indicator show some strength and really shift the longer-term trend back over to positive. It may not play out that way, but just one thing to keep in mind. The financials also had some more weakness, and the regional banking ETF to the financial sector is continuing to show a real breakdown. I brought this back up just because good old First Republic Bank had a 50% drop on Tuesday. We're starting to see some weakness above here with the NYSE advanced decline line dropping below the moving average. The S&P is holding up a little better. The mid caps are still just barely above the moving average, but the small caps, which have been weak all along, are now continuing to show even more weakness. The Dow never could get above this pivot level and has been falling back. On a positive side, we're still above the 50 and 200-day moving averages. The diamonds have now switched over to negative. The NASDAQ, after putting in what could be seen as a triple top, has now been coming down. One positive sign is we're right at this pivot level, and I know that's kind of hard to see, and we're right at about the 50-period moving average. So far for the NASDAQ, support is holding. The NASDAQ 100 also closed just a little bit above this pivot level and is still above its 50 and 200-day moving averages. The Qs have also switched to negative. We fell back down below this 38.2% retracement level at 12,864. We closed at 12,725. The Qs have also broken support, going back to this anchored moving average to the all-time high, which had been a support level that was holding. Now we have broken that. The microcaps were also down, but did not set a new 52-week low. The small caps, which have really been lagging behind after hitting the 200-day moving average, we're getting close to seeing a death cross here, and the small caps were down 2.59%. The RSI for the small caps has now dropped below 50. We're seeing a death cross here, and the MACD is also starting to roll over. So you could make a solid case that the market's really getting geared up to go lower. The Elders Impulse system for the small caps continues to be negative, and small caps really continue to underperform the S&P 500. That is also quite negative. The mid caps fell down below their 200-day moving average after going sideways at this pivot level. That's more negative. The mid-caps have also switched to negative for the Elders Impulse system. The home builders were down just like everything else was, so we're seeing the ETF going down. The ratio is holding up fairly well, and the S&P to the home builders ETF still have a very strong correlated relationship. The 10-year bond yield actually dropped just a little bit under 3.4%, and bond prices were up. And we're seeing a golden cross here with the 7 to 10-year Treasury bond ETF. The MACD is also starting to turn back up, and we're above 50 with the RSI. The MOVE index did tick up a little bit, as did the VIX, still having a real strong tendency to go in the same overall direction. Comparing the S&P 500 to the TLT long-term bond ETF, the S&P is starting to come down, the TLT is starting to come up. Longer term, they have a really strong correlation, but they're still having a very strong tendency in the shorter term to go in opposite directions. Here you have two different looks at the spread between the S&P and the TLT. Our long-term trend is still hanging in there now. If this MACD really starts to roll over, that could be in jeopardy. What we're watching for on this chart is this downward sloping trend line. It looked like we broke out. The MACD was above zero and advancing, so it was holding up. We'll be watching the MACD to see if it begins to roll over. Looking at our possible positive scenarios, I put the PPO studies in there. Long term, we're still above zero. Intermediate term, coming down, but still positive. Short term, we've actually dropped to negative. Here's another chart I haven't shown in a while, the 19-day exponential moving average of the advanced decline ratio. We're still above zero, but declining based on price. We've dropped below zero based on volume. The percent of S&P 500 stocks above their 200-day moving average is still positive, but it is continuing to drop. The 10-day average of the S&P 500 highs minus the lows, I had been pointing this out, meaning that it's positive, but now we're starting to really see a drop down below the 90 level. Looking at the Amex, NASDAQ, and NYSE, and then taking a 5-period moving average of the highs minus the lows, that was another warning sign. It never did go positive and actually showed a little bit of weakness. This is another chart I haven't shown in a while. This is to kind of get the positive backdrop here. By looking at the NYSE breadth thrust, we did go extreme negative in October and then bounced up out of that, and that still applies. But we're seeing a lot of choppiness going around. So this is one of our longer-term positive signals. The ZWEG NYSE breadth thrust recently generated a signal which is also longer-term positive. Looking at our ratios, seeing a breakdown with the Qs to the S&P, also the discretionary is rolling over and large cap growth is starting to turn down when compared to large cap value. Looking at our growth to value ratios, large cap weakness, mid cap weakness, small caps are showing some weakness just a little bit below the moving average. This is another longer term positive sign. The 50-period exponential moving average of the new highs minus the lows, we're still above zero. Looking at the indicator, it's still positive. 2-year Treasury yield, it's spiked up and it's starting to come down. So far has not been providing any significant support for stocks. The staples, we took out these other two spikes that we had been watching and now created a new spike. How high up will this go? If we top out and start to come back down, will that give support to the S&P? What's our outlook for Wednesday? We're still dealing with earnings season. The technicals now, they're negative. We have a weekly MBA mortgage index coming out, durable goods orders will be coming out, and then a number of advanced reports on the goods trade deficit, retail inventories, and wholesale inventories. The whole list of geopolitical events, right now it's about earnings and dealing with inflation and interest rates, any Fed speak we may get, and then any more banking information that may be released. Looking at these stock traders' almanac statistics for April 26th, the Dow is more positive, being up 66.7% of the time. The S&P is a little more neutral to positive, where the NASDAQ is more neutral to negative. We still have a tendency to have a good month of April. Then this chart are the yearly statistics that we look at that are adding more to the positive backdrop longer term. We're on the 17th trading day of the month, where we are up slightly during a pre-election year. Looking at our scenarios, you could go with the down scenario if you're more aggressive because our technicals are now negative. It's really hard to go with the up one now unless we have a monster up day to turn things back looking more positive. Even if we did have a good update, we're still not trending overall. So if you're a little more conservative, you're still looking at the sideways trend. The ADX is weakening because it's below its moving average. We're also below 20. It's also switched back now to negative with the red line on top, and that red line is advancing. If you're more aggressive, you may initiate some positions based on that. So looking at our warning signs, all these negative divergences that I've been talking about, they're starting to come together and really produce a down day. Volume increased on a down day. That's another warning sign. The VIX is still really complacent overall. The S&P continues to underperform utilities. More folks are still favoring a risk-off posture. Small caps continue to underperform. The NASDAQ still looks like it could be declining from that double or potentially even triple top. And then we have earnings season, which could be good or bad, depending on how the market takes those. Now, because we switched over to look more negative, I've also added a positive sign to look at. And if you've watched these videos for any length of time, when we're going down, I'm looking for positive things. When we're going up, I'm looking for negative things. I just don't want to get caught off guard. And so that's why I bring up all these different things throughout the videos. Many of the indicators that we look at are declining, but they're still positive, at least for right now. The longer term positive seasonality and setups remain, those charts that I went through to show you. Lower levels may provide some kind of support. We have some moving averages below us. We have previous lows. We have a lot of different things and a lot of different indexes that may provide support that we could bounce up off of. So our conclusion, the S&P is negative, but it's not trending. Short-term negative and quickly becoming oversold because we're coming out of a non-trending environment, pushing our oscillators down pretty quickly. Intermediate term, we're more just negative currently, but we're still positive in the long term because we're above the 200-day moving average, and we still have the 50 period above the 200 period, which when that cross, that is known as a golden cross. Thank you. I hope you found this video helpful. I hope the sound quality is okay and that you're able to understand what I'm saying. Please feel free to check out the private Facebook group or let me know if you want me to post things in other areas. I'd be more than willing to do that. So have a great day, and I will talk to you in the next video.